It's a great pleasure to welcome you all to this second Sir Andrew Crockett Memorial Lecture. Probably many of you were here and remember his Per Jacobson lecture in 2011 and the great fortitude he showed attending the AGM 3 years ago. We all have many fond memories of Andrew, and this lecture is the BIS way of honoring his many contributions to central banking, and I would like also to say to this institution. And we would like to extend a particular welcome to Marjorie. Marjorie, welcome. So our lecturer today, Amir Sufi, needs little introduction, so I will be brief. He's professor of finance at the Booth School of Business in the University of Chicago. His House of Debt book made him famous. This is a very perceptive and excellent treatment of a key and controversial topic. His analysis of the policy implications of the heavy reliance on debt contributed to many of the debates. I must say that when reading it, I liked it very much. He raised a very important question. Did the debt cause the bubble from 2002 to 2006, or did it simply follow it? I think it is a very interesting question. And he, using different city data, different housing supply elasticity on different cities, is able to come to the conclusion that it was the lending boom that really fueled the house price growth and not the other way around. And this is just one of the many ideas and thoughts that are worthwhile in this book. So I think at this point I would like to welcome Amir Sufi and ask him to take the floor. And thank you for coming.
Thank you very much. I want to thank Jaime, Claudio, Hune, and Philip for the invitation to give the Andrew Crockett Memorial Lecture. It's an absolute honor. So let me jump right in. The title of the talk is Out of Many One, Household Debt, Redistribution, and Monetary Policy During the Economic Slump. So the economic performance of advanced economies since 2007 has been dismal, as many of you know. Here, Figure 1 shows real GDP for the Euro area, Japan, the United Kingdom, and the United States against trend growth in the decade prior to 2007. All four economies have deviated dramatically from their previous performance, resulting in a considerable loss of income worldwide. While there have been some recent glimmers of hope, there's little to suggest that we can actually get back to trend, at least in the short term. So few economists foresaw the stagnant economic performance of advanced economies from 2007 to 2015. And most economic forecasters have been consistently expressed too much optimism over the past 6 years. Economists today find themselves on the defensive, which reminds me of something Keynes said in 1930. If economists could manage to get themselves thought of as humble, competent people on a level with dentists, that would be splendid. And that's how I'm going to approach this lecture today. Hopefully, I will prove competent enough to offer some insight into what explains our current economic malaise, but humble enough to avoid causing as much pain as, say, a root canal. So the economic slump presents a number of challenging issues for macroeconomists, and a productive discussion has begun. I'm going to focus on two of the themes that emerging from the broader discussion, themes that I believe are of utmost importance to central bankers. One is criticism of the dynamic, stochastic, general equilibrium-based modeling of monetary policy. This is usually a representative agent-based model where you have just basically an intertemporal substitution dimension. The second is the recognition today that monetary policy is not as effective as many believed it could be prior to the Great Recession. Charles Goodhart of the London School of Economics, I think, summed it up best when he said, and I quote, "Had you asked, say back in 2005, what would be the effect of a central bank increasing the reserve base of its banking system by a factor of 10 times, most respondents would have predicted massive expansion of bank credit, of the money stock, of nominal gross domestic product, and of inflation. Yet none of this has happened. The central point of my lecture today is that these two themes are directly linked. Monetary policy has been much weaker than expected precisely because economists rely too heavily on representative agent-based modeling in trying to understand how monetary policy works. E pluribus unum, out of many one, is great for the seal of the United States, but is insufficient when we're thinking about monetary policy. During normal times, I'm going to argue monetary policy affects the real economy primarily through what I call redistribution channels that require an appreciation of heterogeneity across households. High-income and low-income individuals respond to monetary policy shocks very differently, as do savers versus borrowers. Monetary policy has been especially weak over the past 7 years because the redistribution channels of monetary policy, which oftentimes are not widely acknowledged, have been severely hampered. In 2012, a Wall Street Journal article examined the situation of a man named Chris Horton, a small business owner who emerged from the financial crisis financially unscathed. As the article put it, with a good income and pristine credit, he has refinanced his $417,000 mortgage on his home in Hermosa Beach, California, 3 times in 17 months, shaving his monthly payments by $390. But Mr. Horton doesn't need the money to buy things. As he said, if you don't need the money, you can get it all day long. Thank you, Ben Bernanke. So, a number of recent empirical and theoretical studies have confirmed the macroeconomic importance of this simple anecdote. I'm going to use this opportunity to highlight this very hot, fresh new research. It's pretty much hot off the presses. Many of these are working papers that are just coming out right now. A consistent message does emerge, which is my central theme, that monetary policy over the past 7 years has been less effective than anticipated because it has channeled interest savings and additional credit to exactly the households that are least likely to change their spending in response. The households that would normally spend most aggressively out of monetary policy shocks are either heavily indebted or have seen their credit scores plummet, rendering them either unwilling or unable to boost spending. So I'm going to have some specific policy recommendations toward the end of my lecture. But my broad goal here is to encourage monetary policymakers to rethink the standard new Keynesian representative agent model that at least some still rely on heavily to formulate and evaluate policy. Advances in both theoretical and empirical research suggest that models used by central banks should incorporate differences across households and recognize the importance of what I call the redistribution channels of monetary policy. A core lesson of these models is that the exact same policy may have very different effects on the economy depending on the distribution of debt across individuals in the economy. And that, I think, is a central lesson for us thinking about why monetary policy has been weak. So let's start with the question, how does exactly monetary policy work? That's a pretty basic question, but I think surprisingly, we still are kind of developing an understanding of how we actually think monetary policy affects the real economy. These kinds of analyses usually begin with a model and then find data to try to understand whether the model is useful. I actually think this is the wrong approach for the same reason that Sherlock Holmes criticized this method in A Scandal in Bohemia. As he says, it is a capital mistake to theorize before one has data. Insensibly, one begins to twist facts to suit theories instead of theories to suit facts. Data availability has exploded over the past 20 years, and we have excellent empirical research actually fleshing out exactly how we think monetary policy works. Let's investigate the facts first, and then think about what theory is most consistent with those facts. One of the central lessons of the empirical research is that there is substantial heterogeneity across households in their consumption response to monetary policy shocks. So let's start with the most direct channel through which monetary policy functions, changes in interest rates. So there's 2 very recent analyses that are really both very nice papers that examine this question. Here's what they do. They basically look at variation in the United States across households in the use of adjustable rate mortgages. And what happened in this situation, these mortgages were originated with an initial fixed rate mortgage in the mid-2000s, but then they subsequently turned into adjustable rate mortgages later. So that obviously led to a major big shock in terms of lower interest payments for these homeowners, given how low interest rates were in the Great Recession and afterward. Let me just emphasize, these studies carefully estimate the causal impact of a rate reduction on spending, which of course is a fundamental parameter that central bankers want to know. And both studies find a very similar result. For the exact same dollar decline in interest payments, households with a lot of mortgage debt respond much more aggressively in terms of their spending. This is on order of magnitude larger, usually about twice as large. These two studies were done independently, very similar strategies, and they both find very similar results. So again, the bottom line is, for the same decline in interest payments, households with a lot of debt tend to react more strongly by boosting their spending. The same pattern is actually found in the United Kingdom by researchers at the Bank of England. They did a more macroeconomic study, and they basically find that in response to an unanticipated change in interest rates, households with mortgage debt adjust their expenditure significantly, especially on durable goods. Renters react to a lesser extent, and outright homeowners, those people who own homes with no mortgage debt at all, they do not react at all to lower interest rates. They conclude based on this finding that heterogeneity in housing debt positions plays an important role in the transmission of monetary policy. So that's one channel, reducing interest rates. Another main channel that we try to use as monetary policymakers is to increase credit availability or to get more credit, especially to the household sector. So we also have fantastic research on that. One of the studies that was just released last month, which I think is very nice, one of the nicest studies I've seen over the past 2 years in understanding the Great Recession, is by Sumit Agarwal and his co-authors. And what they do is look at credit card companies, and they estimate the marginal propensity to spend across households when credit card limits go up. So you get a higher credit card limit, who actually spends out of that? So this figure is just very enlightening. They're showing for you the marginal propensity to spend out of an additional dollar of credit card limit over time. And what do you see? They stratify it by credit score. So those of you not familiar with the way U.S. credit scores work, below 660 is essentially subprime borrowers, very low credit score borrowers, and above 740 is very prime borrowers. What you can see here is a very striking result. People with credit scores that are very low respond very aggressively when additional credit card limits are granted, basically 50 cents on the dollar, okay? And this is all credit cards, not just the credit card that was originated. So this is able to kind of get at the substitution effects as well. As you can see also from this picture, people in the very highest part of the credit score distribution are completely unresponsive. They don't spend at all, even though they have a higher credit card limit. Perhaps the most important effect of monetary policy on credit availability happens through the housing market. Really nice research by Aditya Aladengadi at the Federal Reserve Board of Governors argues that monetary policy easing boosts house prices, which in turn fuels home equity-based borrowing. My own research with Atif Mian has shown, I think quite definitively, that in response to higher house price growth, only people in the lower, say, 60 to 70% of the income distribution respond in terms of their spending. In fact, we find that households in the lowest quartile of the credit score distribution borrow 25 cents for every dollar of additional home equity. That's a very strong effect, given how large home equity increases can potentially be. In contrast, people at the top 10% of the income distribution or credit score distribution are basically completely unresponsive. So let me just show you those pictures from that research. Here on the left panel, I'm showing you the propensity to borrow out of housing wealth by credit score, and you can see this 25 cents on the dollar for people with a credit score below 700. And you can also see that people in the highest part of the credit score distribution are basically completely unresponsive. House prices go up, they don't borrow, and they also don't consume anymore. Consumption data is hard to get, so we can only look at auto sales, but you look at new auto sales and you see this very strong heterogeneity. So again, this is a differential marginal propensity to consume across households when they're getting shocks such as credit card availability or higher house price growth. Now, of course, the standard representative agent New Keynesian DSGE model employed for monetary policy formulation in many countries does not incorporate this large variation across households. Instead, the only channel for monetary policy in those models to affect household spending is through what I would call the intertemporal substitution channel. The representative agent is going to pull consumption forward because interest rates are lower. So it's a harder question. I've shown you some kind of cool facts. Many of you may be saying, well, how do I actually incorporate this into a framework? And that's always been a very hard problem. But thankfully, we actually now have a benchmark model in the thesis work of Adrian Auclair, a former MIT PhD student who was basically a star on the market this year and is joining the faculty at Stanford. In his study, he explores what he calls the redistribution role of monetary policy. He builds a very technical general equilibrium model with heterogeneity across households, and he argues, which I think is correct, that variation in marginal propensities to consume is crucial for understanding the elasticity of aggregate consumption with respect to monetary policy shocks. More specifically, Auclair argues that monetary policy shocks can boost aggregate consumption through two channels beyond the simple substitution channel in the new Keynesian model. First, there is the interest rate exposure channel, which depends crucially on the covariance across the population of interest rate exposure and the marginal propensity to consume. That sounds quite technical, but it's very simple. For example, if you have a lot of adjustable rate mortgages in your economy and you lower interest rates, if the MPC, if the marginal propensity to consume of the borrowers is much larger than the savers who are ultimately going to lose $1 of lost income whenever interest rates fall, then you can potentially get a much bigger effect on aggregate consumption than the substitution effect alone. The second channel, which is more standard, is the Fisher channel, named after Irving Fisher's 1933 seminal work on debt deflation. This depends on the covariance across the population in net nominal liabilities and the marginal propensity to consume. This channel is more standard in the literature, and many people know it. Quite simply, inflation benefits debtors, right? And as long as debtors have a higher marginal propensity to consume than creditors, then that could end up boosting overall consumption. More standard in the literature. I would add a third channel that's not in the Auclair model, but I think could easily be expanded to take it into account. And actually, to be frank, I think it's the most important channel. And that's what I would call the credit extension channel. And that is, if monetary policy can induce the financial sector to channel more of the savings from low MPC savers to high marginal propensity to consume borrowers, then that potentially can have a very large effect on aggregate consumption. Okay, so it's these three channels basically that I would emphasize beyond the simple substitution channel. Channels demonstrate an important theoretical insight. Distributional impact matters. The effectiveness of monetary policy relies on more than just lower interest rates and higher asset prices. Instead, these effects must reach people that have a reasonably high marginal propensity to consume if they're actually going to boost aggregate demand and aggregate spending. The representative agent model misses this key insight. So I'm going to argue, and I have a lecture that's actually the text and has a lot more footnotes and support, but I would argue that prior to the Great Recession, that these redistribution channels of monetary policy were the most important reason why monetary policy boosted the economy. And I think, as I said, there's a lot of research, both theoretical and empirical, that would support that channel. The intertemporal substitution channel of the new Keynesian model, to be frank, is just even theoretically hard to imagine that it's large enough to really boost aggregate economic activity. So then, why has monetary policy been weak now? That's kind of the core question. My argument is that monetary policy has been weak because these same redistribution channels of monetary policy have been severely hampered. So let me give you some examples. First, monetary authorities have been either unable or unwilling, I'm not going to take a stand on that, to generate significant inflation. As a result, the Fisher channel is basically inoperative. Second, in many countries, and this applies probably to the United States more than any other country, the interest rate exposure channel has been severely weakened because of the inability of large swaths of the population to refinance their debt into lower market rates. That problem gradually was fixed over time, but was a huge problem at least until 2012, and I would argue even into 2013. Third, the credit extension channel requires that households with a high marginal propensity to consume have significant unused debt capacity. Such households have suffered major balance sheet problems over the past 7 years. As a result, lenders are unwilling to supply credit to these households, even though their own cost of financing has been reduced significantly. And some households that normally spend aggressively out of higher income or higher credit have been much more conservative and are instead paying down debt. The credit extension channel, therefore, has also been very weak. So I'm going to focus on three empirical areas to kind of support this argument: the housing market in the United States, recent evidence on credit cards, and weak consumer lending in the euro area. So the failure of the housing market to boost the U.S. economy serves, in my view, as one of the strongest examples that the redistribution channels of monetary policy have been hampered. We know from research already cited above that the elasticity of spending with respect to interest savings is largest for households with high debt burdens, especially high mortgage loan-to-value ratios. However, it is precisely these households that have had the most difficulty actually refinancing their fixed-rate mortgages into current market rates, something I want to show you on this picture. So what I do in this figure is I basically take zip codes in the United States, typically have about 3,000, 4,000 people living in them, and I'm splitting them into zip codes in the top quartile of the number of underwater homeowners. So some people use the term upside down in other countries. This is when the mortgage balance is higher than the value of the home. And I'm splitting, the blue line is zip codes that have very few underwater homeowners as of 2010. And the red line is zip codes that have many underwater homeowners. And what I'm plotting for you here is the share of mortgages that are refinanced into lower rates. And you see something pretty dramatic. In zip codes where there are few underwater homeowners, perhaps unsurprisingly, a bunch of people are refinancing their mortgages into lower rates. That's a great thing, I think, for the overall economy. However, in zip codes with a lot of underwater homeowners, they're not able to refinance their mortgages. And the reason is when they go to the bank requires you to have a minimum amount of equity in your home, and they don't have that equity. So they're unable to actually refinance into lower rates. Research by my colleague Eric Hurst, I think, has pretty convincingly demonstrated that this kind of friction has depressed overall consumer spending. He looks at the microdata to see who's buying things and shows that in these same zip codes, buying has been depressed beyond the simple explanation that these are zip codes that are in economic trouble. But it's not just the interest rate exposure channel. That's the most obvious thing. But I think also borrowers today are either unwilling or unable to use housing collateral to finance consumption as they did from 2002 to 2006. Here's an instructive example that I like to give. Many people may not know this, but in the United States, house price growth from 2011 to 2013 was actually just as strong as it was from 2004 to 2006. We know in one case, we had an enormous boom in construction, we had an enormous boom in consumption, and in the other case, the economy is pretty much stagnated. Now, my argument is that it's very easy to understand why house price growth from 2011 to 2013 did not boost the economy if you appreciate heterogeneity across households. And I think a lot of economic forecasters made that mistake of not doing that and basically believed this was going to generate really strong growth. Here's what I mean. The households that most aggressively borrowed and spent out of home equity from 2004 to 2006 either A, lost their home in foreclosure and therefore don't own homes anymore in 2011, or B, are underwater and can't do a cash-out refinancing, can't go out and look for another home. So even though house price growth was the exact same during these two time periods, in the earlier period, it fueled cash-out refinancing, which is just to say people took money out of their homes, and we've shown generally spent it on goods and services, and you see a huge boom in construction. If you look at the recent period, you see much weaker effects. And this is exactly, again, because different households are experiencing house price growth during the later period than the former period. So let's discuss credit cards. I've already shown you some evidence on credit cards, but I think it's broader than just the example I've already shown you. A common strategy by central banks to boost economic activity during a downturn is lowering the cost of capital for financial intermediaries. For example, the targeted longer-term refinancing operations by the European Central Bank is a prime example. We know from research cited already above that credit extension via credit cards to low credit score households would boost spending considerably. So why have lower interest rates for financial intermediaries not translated into more spending by households? So the same paper by Agrawal et al. I think really helps to explain why. And what they do, given they have this enormous nice data from the OCC in the United States that has basically the universe of all credit cards, and they're able to estimate using kind of clever techniques both the causal effect of lower financing costs on credit card extension of credit and the causal effect of credit card extension on the propensity to actually spend by the households. So they can actually trace the full transmission from lower interest rates for the intermediary to spending to the households. And what do they find? They find this fantastic result, one of my favorite pictures that I've looked at in the past 2 years from empirical research. The picture on the left shows you how credit card companies respond to a lower cost of capital. In particular, it's the marginal dollars lent for a 1% reduction cost in capital. And they show that across the credit score distribution. And who do credit cards lend to? This is again from 2008 to 2013. They lend to basically people with very high credit scores. Then they estimate the marginal propensity to borrow over the same time period. What do you see? You see that the marginal propensity to actually spend and borrow out of credit card availability is strongest among low credit score individuals and almost zero among high credit score individuals. So in other words, credit card companies lend to people that do not spend. And that is a big reason why the lower cost of capital for financial intermediaries has not boosted aggregate consumption considerably. They do a really nice calculation which I think points out the drawbacks of the representative agent model. And I'm quoting them. Suppose the effect of a decrease in the cost of funds was naively calculated as the product of the average marginal propensity to lend and the average marginal propensity to borrow in the population. We estimate that such a calculation would overstate the true effect of a decrease in the cost of funds on total borrowing after 12 months by between 132 and 166%. Okay, so the representative agent is just going to get it wrong by an order of magnitude precisely because they're not appreciating the fact that credit cards are lending to people that actually don't spend out of that additional credit availability. So up to this point, I focus mostly on the United States. This reflects the fact that, to be frank, research using microeconomic data has advanced a bit more quickly there than in the rest of the world. However, a growing body of research out of central banks in other countries, and that's one message I would give for those of you here from central banks, is I really hope that this research is supported and built upon, because some of this research using microeconomic data is giving us very new insights into the way monetary policy actually works. So let me give you some example. Philip Bunn and May Rostam study microdata from the United Kingdom and show that high levels of household debt have been associated with deeper downturns and that cuts in spending associated with debt were a drag on consumption during the recent recession. Anderson, Deuce, and Jensen use microdata from Denmark and show, quote, a strong negative correlation between pre-crisis leverage and the change in non-housing consumption during the crisis. The microeconomic data support the argument that we see in the United States that elevated debt levels have depressed borrowing and spending in Europe. The macroeconomic evidence also supports this view. As the most recent ECB Financial Stability Review put it, on average, bank lending to euro area households has remained subdued, mirroring sluggish dynamics of household income, high levels of unemployment, and housing market weakness in some countries. Even extraordinary monetary stimulus in the euro area has had a limited effect on lending to households. And you can see that here in Figure 8, that basically household lending, outstanding consumer debt, has been falling, not rising during the last few years. So in my view, the main friction facing monetary policy is that the redistribution channels normally at work have been broken. Representative agent models have an alternative reason why monetary policy isn't weak: the zero lower bound on nominal interest rates. And many of you may have been thinking, what about the zero lower bound? What about the zero lower bound? That must be part of the explanation. Look, don't get me wrong, the zero lower bound has to be important. Even models that I use a lot in my research that rely on debt and distributional issues rely on the zero lower bound. It's of course an important issue. But let me be frank here. I believe that economists have overplayed the zero lower bound nominal interest rate card. Obviously, it's one of the reasons monetary policy has been weak, but it's not the only reason. Let me show you some evidence of that. So the panel on the left is showing you what most of us know here, and that is that the United States entered the liquidity trap in November of 2008. I'm using the 3-month Treasury rate. You could use other short rates as well. However, let's look at the 30-year mortgage rate, which in my view is far more relevant for thinking about how households actually respond. If you had one interest rate you're putting into a new Keynesian representative agent model, I would argue it's probably more the 30-year mortgage rate than it is the 3-month T-bill rate. What do you see? You see that from November 2008 through basically January of 2013, mortgage rates in the United States fell from 6% to 3.3%. That's a stunning 270 basis point drop. Okay? Now, you can obviously argue that in the absence of the zero lower bound, the mortgage rate would have fallen even further. And of course, it would have. But my central point here in this picture is that one cannot argue that mortgage rates have been constrained at an artificially high level over the course of the Great Recession. They fell dramatically. And even with them falling dramatically, it did not boost economic activity significantly. Well, that's too strong of a statement. It didn't boost us to getting back to trend. It may have actually helped a lot, but not enough to actually get us back to trend. Now remember, the redistribution channels of monetary policy can very easily explain why this interest rate can fall rapidly and yet the economy doesn't boom. And that is, the people that can actually borrow at this rate don't spend that aggressively, don't buy new homes, and the people that normally would borrow simply don't have access to these interest rates. Let me put it another way. Imagine a counterfactual world, a counterfactual mortgage market in the United States in which high marginal propensity to consume households with mortgages all had their interest rates immediately reset to 3.5% in 2009. Or alternatively, imagine that households with low credit scores were able to borrow as easily as they did during the housing boom at prevailing rates of 3.5%. I'm not arguing this would be advisable or a good thing, but I'm just saying that either counterfactual world would have seen a huge boost in household spending. And I think that's the reason I think the zero lower bound alone cannot explain why consumption has been weak over the past few years. So what are the policy lessons from this framework? The most obvious policy lesson from this framework I've outlined here is more aggressive restructuring of household debt burdens. Atif Mian and I have made this case forcefully elsewhere, including an extensive discussion of moral hazard and the danger of imposing losses on a weakened banking sector. As I have written, I believe that failure to more aggressively tackle household debt was one of the biggest policy mistakes of the Great Recession. However, I believe I'll be less controversial today, try to be more fruitful by focusing on other issues. I appreciate the fact that debt restructuring on a wide scale is politically explosive, and to be frank, it's widely outside the purview of central bankers. Further, the benefits of household debt restructuring today are likely significantly lower than they were, say, 5 years ago. Making matters even more difficult, a private debt problem in Europe has been transformed into a public debt problem, leading to a wider set of issues that are far too complicated for this lecture. All of us are following Twitter, understanding this, right, this week. For all of these reasons, let me discuss other policy recommendations. So I want to start with monetary policy. What does this framework mean about optimal monetary policy stance? You could argue that in reduced form, this is basically just saying the IS curve is steeper, so you got to push even harder, right? So people are less responsive, so you got to even push harder to get rates lower. Obviously, people here at the Bank of International Settlements, as we've seen, have an alternative viewpoint about why potentially keeping rates too low for too long might be problematic. This is what former Federal Reserve Governor Jeremy Stein calls the Tylenol dilemma. And I'd like to thank Jeremy for letting me use this because I don't think it's actually in print. He told me in an office meeting of this, and I thought it was fantastic. So he gave me the permission to use it. So the Tylenol dilemma is the following. A patient is rushed into an emergency room after a terrible car accident, suffering many broken bones and other ailments. You as a doctor have available only Tylenol to treat the patient. So how much should you give? As Professor Stein has pointed out, it surely depends on the side effects of Tylenol. This analogy, in my view, helps really unpackage the heated debate on monetary policy when the transmission mechanism is weak. In particular, many have argued that extraordinary monetary policy efforts such as aggressive quantitative easing have distorted asset prices and raised financial stability concern, potentially nasty side effects of an extreme dosage. But others counter that taking away the drug from the patient leads to unnecessary suffering. How can we withdraw the medication when the patient is still in serious pain? One of the very nice things about this Eau Claire redistribution framework is it actually offers a lot of insight into why this debate is, frankly, quite heated and why it's so difficult. Eau Claire points out that when you actually take into account heterogeneity across household, a natural asymmetry comes about, that lower interest rates do not boost consumption as much as raising interest rates will actually reduce consumption. So you have this, what I call monetary policy asymmetry predicament. And the logic of that, if you want to follow it, it comes straight from the notion of credit constraints. And that is, if I'm a credit constrained borrower and I get a savings shock or an interest payment shock, so my interest rate falls below what it was before, any credit constrained borrower is going to save at least some of it because they're worried that the constraint's going to be binding in the future. So they're not going to spend all of it. In contrast, if my interest rate goes up, I'm going to cut consumption one for one. Okay, that's the logic of this asymmetry. And I think this asymmetry is really nice because it helps explain something, a problem that everyone in this room knows. The central bankers are effectively in a very tight spot, right? Keeping interest rates low may not boost consumption a lot, but raising interest rates may have a dramatic effect on consumption. So given this asymmetry predicament, where do I come down? I tend at the end of the day to agree with continuing to administer the pain reliever. While the side effects, in my view, are no doubt worrisome, I weigh more heavily the tangible pain that will be there when rates actually go up, especially if they go up prematurely. We have research out of the US, out of the Bank of England, out of the Resolution Foundation in the United Kingdom, pretty carefully showing that you will actually see potentially a significant reduction in household spending and potentially problems, especially in the UK, actually making mortgage payments if rates were to rise too quickly and too rapidly. Don't get me wrong, I'm from a finance background. I fundamentally do believe that monetary policy is having some worrisome effects on asset prices, on financial stability, and I agree it's a very dangerous and hard problem. But at the end of the day, the tangible effect of raising rates earlier than you otherwise would, for me, is more tangible than what I see to be less tangible financial stability concerns and exactly what we're preventing by raising rates early. I also want to discuss institutional and regulatory issues facing central bankers. So what I've argued here is that the ability of monetary policy to boost economic activity will be severely diminished when there's limited debt capacity of households with a high marginal propensity to consume. This is a key lesson coming out of this research on the redistribution channels of monetary policy. Central bankers should worry about this because we have an increasing body of research that shows the most severe recessions tend to come after a large increase in household debt, which is exactly the thing that's going to make monetary policy, to be frank, impotent ex post. So we have to really think about this problem. So for example, I've been doing research with Atif Mian and Emil Werner, and we have great data from the BIS on 30 countries over the last 40 years, and we run simple forecasting regressions showing that sharp rises in household debt from, say, 4 years ago to last year forecast low GDP growth over the subsequent 3 or 4 years. This builds on research that we've done in the United States showing areas of the country that had the largest rise in household debt had the most severe recessions and severe drops in consumption. Other researchers, for example, the fantastic work by Yorda, Schulerick, and Taylor, have also shown that recessions associated with elevated household debt tend to be the most severe. And of course, people here at the Bank of International Settlements were onto this point very early, and they've been instrumental in developing our understanding of the importance of household debt in forecasting bad things for an economy. Now, one must always use caution when forecasting out of sample. But I believe we have enough evidence at this point to justify things like macroprudential regulation limiting household debt in the housing sector. This is something the United Kingdom has implemented, for example, in July of 2014, and I definitely think it's a great idea. There's also at least preliminary evidence that I've seen that it actually works, at least in cooling house price growth in the southeast of the UK. This has also been done, for example, in Sweden, in Israel. It's been done in South Korea, and I think we need more research on it. We need more understanding if this is an effective methodology for actually limiting household debt. Fortunately, I don't want to be a doomsdayer. If you actually look at the data today, household debt doesn't seem to be nearly as big a problem as it was from 2007. So let me just give you some numbers. The primary variable we use in our research is the change in the household debt to GDP ratio from 4 years ago to last year. In 2007, obviously the peak year, I'm choosing that on purpose, the average across our sample was a rise of 7.5 percentage points. That is to say, prior to 2007, there was a very large run-up in the household debt to GDP ratio. The 3 countries in the largest increase as of 2007, you could probably guess, Ireland, Spain, and Greece, all of which obviously subsequently had very severe recessions. Today, if we look at the same number across the 30 countries, the latest data we have actually is 2013, comes in at a bit of a lag, it's about 0.7 percentage points. So remember, it was about 8 percentage points in 2007. It's not even 1 percentage point today, which reflects the fact that many countries have actually seen deleveraging. The 3 countries with the largest increase have been Thailand, Singapore, and Greece, although Greece is more driven by the denominator, GDP going down, rather than household debt going up. If you look at one thing I did discover in this speech, putting it together, if you look, South Korea and Hong Kong are actually 5th and 6th on this list. So 4 out of the 6 countries in the top 6 are in fact in East Asia, which suggests maybe there is some concern in that part of the world. But overall, household debt is not growing rapidly at the global level. It is worth considering macroprudential regulation of household debt burdens as a policy tool, although it may not be needed in most countries at this time. So while macroprudential regulations on household debt are advisable when household debt burdens are growing, the longer-term solution requires a direct attack on the use of debt as a financial contract. As we argue in our book, the key problem with debt is its inflexibility when the economy collapses. Losses are shared unequally, with high marginal propensity to consume debtors experiencing the largest losses. The reduction in consumer spending by debtors overwhelms the economy, and monetary policy is poorly positioned to clean up afterward. The longer-run solution must be institutional changes that stop encouraging the use of inflexible debt and instead promote more contingent contracting. The most ambitious proposal we make in our book is to have household debt that is indexed to a measure of economic activity, such as house prices or GDP growth. We call this a shared responsibility mortgage, which would see the principal balance on a mortgage fall automatically if house prices in, say, your neighborhood fell. Lenders, in turn, would capture some of the upside if there's a capital gain. The core idea, of course, is to make the mortgage more equity-like and less debt-like. An interesting related idea is the ratchet mortgage by Bert Eli and Andrew Cullity. It is essentially a one-way adjustable rate mortgage where the interest rate paid by the borrower is tied to a long-term government bond such as the 10-year Treasury bond. The key characteristic is that the interest rates only adjust downward. If the reset formula yields a higher interest rate than the current rate paid by the borrower, then the current rate prevails. Of course, the cost of financing is going to be higher for such an instrument, but given the externalities associated with leverage, I think maybe higher interest rates is what we should have on some of these instruments that are at least protect households more on the downside. Both of these ideas rest on the assumption that a key function of the financial sector is to promote better risk sharing. In particular, I believe policy efforts should encourage the use of financial products that reduce the wealth losses of high marginal propensity to consume individuals during economic downturns. It is more efficient from a macroeconomic perspective to have low marginal propensity to consume individuals bear more aggregate risk. At the end of the day, I'm a Chicago economist, so of course they should be properly compensated for taking that risk, having higher expected returns. Governments throughout the advanced world promote financial arrangements that actually do the exact opposite. For example, encouraging the use of debt through the interest tax deduction in many countries. We need to rethink what the financial sector is supposed to do and what the ancillary benefits would be more effective monetary policy when it is needed most. So in conclusion, I want to express the honor I feel for being invited to give the Andrew Crockett Memorial Lecture. I use the invitation as an opportunity to read more carefully Andrew Crockett's work, and I was incredibly impressed with his ability to extract practical real-world lessons from more abstract intellectual ideas. While much of his writing focused on the goal of preserving financial stability, he had a deep appreciation for issues surrounding debt burdens in general. In a paper written in 1997, he noted, "A number of writers have pointed to the possibility that an excessive buildup of corporate and household sector debt during a period of economic expansion carries the danger of exacerbating recessionary tendencies when the downswing in the cycle comes around. This is because a weakening of economic activity both increases the difficulty economic agents face in servicing their outstanding debt and reduces their net worth, making it harder for them to engage in further borrowing. There can be little doubt that excessive debt levels have a potential role to play in transmitting the effects of financial stability into the real economy." I agree wholeheartedly. Indeed, we all stand on the shoulders of giants. Thank you very much.